Thanks so much for joining us this evening for our 2023 mid-year outlook. Some of you were here for the beginning of the year, the January outlook. We brought in a different economist of ours. Today we've got Bryce. Bryce works with First Trust. First Trust is an investment company we use to fill some of the strategic positions we're looking for in our asset allocations. And they're kind enough to also lend us some of their credible resources, their incredible resources when we need that, right? So we're very fortunate to have Bryce here. This is going to work very similar to the last event we did, right? Bryce is going to hit a bunch of high-level sort of things. He'll talk for about 20 minutes. And then what we want to do is the last 15 to 20 minutes, or however long you want to hear us, we're going to have a bit of a panel up here with Bryce, myself, and Jacob to either go into more detail on some things that you saw, or maybe there's questions you have on things that we didn't address, right? Okay? And if it all goes well, 7:15-ish, you should be able to get out of here unless you want another drink, and I'll stay with you for that. Okay? Please help me welcome Bryce. Thank you, bud.
Well, thank you so much, Jay. It's great to be with all of you guys. I've been doing things with Jay since this pandemic kicked off, so I really feel like we've sort of gone through the ringer with each other. It's obviously been crazy, and not just in the investment world, but in our everyday lives ever since COVID happened, right? So I titled this Volatility Has Arrived. I'm going to focus mostly on financial markets today, obviously, but hey, volatility has been everywhere. It's everyday lives, it's geopolitics, it's across the spectrum. And so, guys, I think specifically today, the markets, once again, have surprised a lot of people. This year it's been all about AI. There's been 7 big names that have really driven things. And so, people are looking around wondering, hey, can this rally continue? Are we almost done with inflation or not? Are we going to have a recession or not? And so these are some of the big questions I'm going to try and answer, and then we'll do some Q&A with Jay as well. So with that, guys, let's get into it. Let's talk high level. Once again, thank you so much for coming out, guys. I really appreciate you all being here today. So first thing I want to talk about, guys, before I even get into inflation or like a recession or any of that stuff, is the U.S. dollar and its reserve currency status. Okay, because I've been getting constant questions about this, and we're always getting questions about reserve currency status of the dollar from financial advisors, but now it's normal people asking. I'll have like my Uber driver will ask me about this stuff, or my cousin will text me about it, right? And so, hey, the market goes up, market goes down. Who really cares if the U.S. dollar is not worth anything anymore, right? It's what all of our financial assets are priced in. And so the big worry that a lot of people have today is really centered around the petrodollar. Basically, there's been all this news about Saudi Arabia might sell oil in the yuan, which is the Chinese currency, or Brazil did a natural gas deal in yuan. And so, I think it's worth addressing this because I don't think the U.S. dollar is going anywhere, guys. And the petrodollar and whether fossil fuels are sold by Saudi Arabian dollars or not, I think it's become a lot less relevant over time. And the petrodollar system, guys, high level, the 1970s, the United States goes off the gold standard, right? The dollar's no longer backed by gold. And on top of that, we have a massive energy crisis, right? We get embargoed by OPEC. We have the gas lines is the number one thing people usually think about. And so, we send over some diplomats over there to Saudi Arabia, and the idea is to kill 2 birds with 1 stone. Essentially, the deal was, listen, Saudi Arabia, you're worried about the monarchy being displaced by radical Islamists. How about we give you some military support, some intelligence support to keep you in power? And in return, what you give us is you never embargo us on oil again, and you start selling your oil in dollars. And it sort of built an intrinsic value back into the currency, right? You can't get gold anymore for $1, but you can at least get oil, and everybody needs energy, okay? This deal made a lot of sense because in the 1970s, the United States was a net importer of energy. Okay, and that's the chart I have up on the screen. That's in your packets. This is the U.S. energy trade balance. So dollar value of exports minus dollar value of imports. If we import more energy than we export, on net we're relying on somebody else, and they can use that against us, right? And so we're a net importer of energy for 50, 60 years. This hits its peak around 08, 09. And in the aftermath of the great financial crisis, something big happens with U.S. energy production. Right around 2013, 2014, and that's the widespread adoption and commercialization of hydraulic fracturing, okay? The United States in a very short period of time becomes the largest producer and exporter of energy in the world. We produce more oil than Saudi Arabia. We produce more natural gas than Russia. You know, the geopolitical leverage has really shifted back in our direction, okay? And that's why you see us being able to do these Russian oil embargoes, for example. It wouldn't even be an option 10 years ago. It's why we can step in and help Europe. And so the petrodollar, we don't really need Saudi Arabia on our side anymore. Say you're Bangladesh and you want, you know, you've got a bunch of dollars, you want oil, well, you can just come straight here to Texas to get it now, right? So it really has, I think, shifted things in our favor. And by the way, you know, inflation's still a problem, guys. I'm going to talk more about that. But when you compare the United States to the rest of the world, we really are, in relative terms, doing much better. It's because, you know, we're not the ones having an energy crisis today. It's the Europeans that are having an energy crisis, right? So I think there's some big advantages that we have as a country right now, guys. And, you know, the dollar's not going anywhere. I don't think the petrodollar system matters that much, just because, hey, we're net exporters at this point. So let's talk about inflation, guys. Obviously, this is sort of the biggest thing going on in the investment world these days. We haven't had inflation in the United States like we've had in 40 years, okay? Anytime inflation gets as high as it does, Federal Reserve steps in and starts hiking interest rates. And that's what we just went through, was the fastest period of interest rate hikes since the Paul Volcker days in the 1980s. Anytime interest rates go up, it's a headwind to, you know, financial asset values. Because the way you value financial assets is really two variables. One is profits and one is interest rates, right? And so inflation, in my opinion, has been massively overcomplicated by politicians, by the news, by whoever during this whole COVID era. Inflation is just too much money chasing too few goods. It's exactly what you learned in Economics 101. I don't think we need to make it more complicated than that. What did we do during the pandemic? We printed a lot of money and we shut down the global production system, right? Fewer goods and more dollars. That's how you get a 40-year high in inflation. Now, there's a lot of good news this year on inflation, right? That headline inflation rate has fallen rapidly from about 9% to 3%. I think we have some longer-term challenges with inflation. I will talk about those next. But the bottom line, guys, is there's been a lot of good news on inflation. And so you look at the stock market doing so well this year. Part of it is AI euphoria, right? A lot of these companies invest in AI. Part of it's just that inflation's gotten a lot better, and we know, hey, we're getting towards the end of these rate hikes, right? And, you know, typically those types of stocks, they have higher multiples. They do well when there's less, you know, volatility in interest rates, okay? So I want to talk about why I think we've had so much progress on inflation this year. It's about the too much money side of the problem, in my view, okay? The chart that I have up here, this is the M2 money supply, and I've just done a year-over-year change on this chart. So how fast is the M2 money supply growing? What is M2? Why should anybody care about this in this room? This is what we call high-powered money in economics. It's basically dollars in people's hands they can go out and spend, right? If I print trillions of dollars up and I bury it all in the ground, it can't affect consumer prices, right? Because no one can go and spend it on anything. That's, by the way, basically what happened in 08, 09. We printed a lot of money. Quantitative easing is the term you might have heard, okay? But we stuffed all those dollars into bank balance sheets, into excess reserves. Normal people never got their hands on that money. M2 never really grows in 08, 09. 2020, 2021, very different story. We printed up about $5 trillion, and, you know, we didn't stuff it in bank balance sheets. We just sent checks to basically everyone in the country, right? Stimulus checks, boosted unemployment benefits, PPP loans. When I say $5 trillion, by the way, it's like numbers get big enough, they don't even mean anything anymore, right? They lose context. $5 trillion is what we spent on all of World War II in inflation-adjusted terms, right? At least back then we were building factories and ships and infrastructure, right? So end of the war, instead of making mortar shells, the factory can make like refrigerators or something, right? Well, we didn't build anything with all this money we printed. We just sent checks out, right? So demand goes way up without supply going up. A lot more money in the system. I think this is why inflation got as bad as it did. And now the good news is, Federal Reserve stepped in, it raised interest rates, tightened monetary policy. We stopped sending checks out all the time. Growth rate of the money supply has fallen rapidly in the past year, right alongside that headline inflation rate, right? So essentially we've just stopped throwing fuel on the fire, right? We stopped adding more and more money to the system. That's why that inflation rate has improved. That's a big reason why the market is rallying. It's a big reason why some of these growth and tech names are doing well. They have higher multiples. They are more sensitive to interest rates and interest rate volatility. So there's been a lot of good news on inflation, guys. I think we are getting towards the end of these Federal Reserve rate hikes. I don't think we're going to see like a 3% mortgage rate anytime soon, unfortunately. I'll talk about why next. But don't expect interest rates to continue to surge like they have been, okay? Because we've really solved the too much money side of the problem. So let's talk big picture why I think we are going to have some challenges about getting to 2% inflation on a consistent basis. All right, and 2% inflation, guys, is just the status quo for the last 40 years. It's what like the Federal Reserve's target rate for inflation is. It's sort of what everybody thinks of as normal, okay? And I think a lot of things are happening around the world that are going to make it difficult to get to that rate. Specifically, we're seeing a lot of changes with global trade. We're seeing the United States begin to reshore a lot of industry, all right? And the upside of all of this is U.S. employees, I think, are starting to see their bargaining power rise. I think the country becomes more self-sufficient, but I do think it's going to have challenges with regards to inflation, okay? Now, I was in Austin the other day. I went to Chipotle. On the front door, what did it say? It said $20 an hour plus pet insurance and like emotional health days and like anything you can think of to get people in the door, right? Think about that. That's pretty amazing, guys. Like 3 years ago, okay, we were talking about $15 an hour. That was the goal politically for the Democratic Party, and we've already blown way past that, right? So we've seen crazy wage increases on the bottom end of the spectrum. I think that plays right into what I'm going to talk about here, okay? So what I've done in this chart, I've graphed out compensation of employees as a percent of national income, and that's sort of complicated, guys, but the way to think about it is national income either goes to employees or it goes to owners, right? It goes to one or the other. It's labor versus capital, okay? And so I just think about that orange line as employee bargaining power in one line, and I've charted out CPI inflation next to it, which CPI stands for the Consumer Price Index. You turn on the news, you see an inflation rate, that's typically what they're talking about, is CPI inflation, okay? We think of the 1950s and the 1960s very nostalgically in the United States because that was the golden age of the US middle class. Okay, a normal person working at a factory could have a wife and 2 kids and a couple of cars and a house in the suburbs and a defined benefit pension plan and go on vacation twice a year, right? That is not the status quo anymore. So what created this unique set of circumstances back in the 1950s and the 1960s? I think it was World War II. All right, World War II destroyed the industrial capacity of basically every other country in the world except for the US. We were the only ones that didn't get touched, right? So what that meant was we became the monopoly producers and exporters of basically everything in the world after that war. And hey, that means you got to hire US employees, right? During this period, because of that, labor negotiating power is rising. This coincides with big spikes in inflation. Now, we were printing money back in the 1970s to pay for Vietnam and the Great Society programs under LBJ. There's other things just besides just labor negotiating power, but this was a contributing factor. Theoretically, why is this? If more and more of national income goes to employees instead of owners, they're more likely to spend it on consumer goods. Whereas if all the income goes to the top 10%, like after 08-09, that's what we talked about for a decade, right? Well, you don't really see those people spend all that money on consumer goods. They save most of it, right? So the inflation happens in financial assets. During this period of time, hey, demand basically outruns supply. This is the case up until around the mid-'80s, early 1990s, right? Then you start to see employee negotiating power fall right along with inflation. Why is that? Well, we have a massive boom in globalization. Okay, the Soviet Union collapses. Half the world joins the Western markets. It's a lot of cheap labor and materials. 10 years later, China joins the WTO. They bring 1 billion people in their labor force with them. Labor and materials become globalized commodities. And in this case, it's mostly labor that we care about, okay? Because labor is 60 to 70% of a business's expenses, right? If you can cut those labor costs significantly, by, say, shifting your factory abroad, okay, it's going to be great for your profits as an owner. It's going to be great for consumer prices, right? You're going to pass on savings to the end consumer. Consumer price inflation falls, right? However, the loser is going to be domestic U.S. labor, right? You're now competing with somebody in China making a fraction of what you do. So, hey, labor negotiating power is falling because, again, this is the era of outsourcing, right? Now, this happens right up until about 2020. At that point, we see CPI, inflation spike again. Money printing was part of it, right? But labor negotiating power starts to rise as well. Okay, this starts off because we pay people not to work, obviously. But there's three other things I think going on here that are going to keep this rising for the foreseeable future. One is we destroyed supply chains in this country. The status quo around supply chains no longer works. Okay, and now there's all this concern around geopolitics with supply chains. Does it make a lot of sense that all the semiconductors are made in Taiwan, a stone's throw from China? Probably not, right? If we want to do a huge green energy transition in the United States, we can't just let China make everything for us, right? It's a big risk. You can't just put your energy in the hands of a geopolitical rival. That's that first chart, right? We did that with Saudi Arabia in the 70s. It didn't turn out well. Europe just did that with Russia. It didn't turn out well, okay? So we've seen a lot of legislation to bring back production of certain strategic industries to this country. Well, U.S. labor has to man those factories, right? So demand for U.S. labor goes up. We have the lowest energy costs in the world. I showed you guys that chart, the first chart, right? Hey, if you're an energy-intensive manufacturer, you're probably going to bring your production closer to home. And the last one, guys, and really the most important here, in my opinion, longer term, is the era of really cheap labor abroad is coming to an end, okay? Everyone knows about China's population having peaked. They're the headline grabber. It's basically everywhere, though. South Korea, Vietnam, Eastern Europe. Go across the board, populations are peaking and beginning to fall. It's outside the scope of what we're talking here today, right? The intricacies of demographics, but it's happening. All right, and so all that cheap labor is drying up. It means relative wages in those places rises. It's no longer as attractive to now produce everything abroad, right? So that's another thing, pushing jobs back into this country because, hey, we're the ones that buy everything anyway. Why not produce it closer to home, okay? So if I'm right, and we have a long-term upward trend in employee bargaining power happening here, well, the last time that happened, we had a durable problem with inflation as well, okay? Now, optimistically, you could say AI comes in here and helps us a lot, right? Technology ultimately does save the day, typically, but it's not something that I think can happen in like 12 months, right? It's going to take longer than that. So this, I think, is the risk longer term with getting to like a 2% inflation rate consistently. What that ultimately means is I think interest rates just stay at this higher level for a longer period of time. So we can't really rely on a huge decline in interest rates in the market at this point, in my opinion. All right, so last thing I'll show you guys is one reason why we're concerned about a recession at First Trust. Okay, and guys, I'll start off by saying it's one of the hardest times to ever forecast because the massive pandemic measures that were taken distorted everything in the economy, all the economic data, and things we typically relied on in the past are just not as reliable anymore, okay, for forecasting. But last year, a perfect example of this is we had 2 negative quarters of GDP growth in a row. And if any of you guys read the news or follow financial media or any of that stuff, you'll remember this. Okay, that's the rule of thumb for a recession typically. It's a pretty good rule of thumb. But we came out at First Trust last year and said, we don't buy it. We think this is a head fake in the data. Everything's been distorted by COVID policy. And so I want to talk about that with this chart on consumer spending because the same reason we didn't think there was a recession last year, I am worried about one today, okay? So what I've done here is I've just charted out spending on goods and spending on services. The reason we care about consumer spending, it's the biggest single component of GDP in the United States, like 60, 70%, okay? So it really dominates. I inflation adjusted all this, guys, and really the big thing is there's trend lines I've added, okay? And what those are there to show is what normal would be. So, if the pandemic hadn't happened, where would spending on goods and spending on services be at? Okay, I think it's like our best idea of a baseline here. Early on in the pandemic, everyone's stuck at home. We're not going to restaurants and bars. We're not going on airplanes. We're not getting haircuts. Spending on service drops off a cliff. We are all buying a lot of stuff from Amazon, though. We're going to Home Depot. We're doing, that home improvement project that you put off for the past few years, okay? Everyone's buying grills. Big green eggs are impossible to find, okay? Spending on goods surges. Eventually, vaccines come out. Lockdowns end. All this reverses, right? Spending on services begins to rise. Spending on goods begins to fall. And so we were still in the middle of this, I'd call it like a normalization last year. Okay, so our big point was you're going to see headlines of big companies laying people off. Okay, but this is going to be mostly in the consumer goods sector. And it makes sense, right? Demand for their products is falling. However, if services are in recovery, they're a bigger part of GDP and employment and consumer spending than goods are, they can basically bail out the broader US economy. So think about a really easy way, all right? Somebody gets laid off in an Amazon warehouse and they get hired at Chipotle instead. That's like the simplest mental model I could think of here, okay? And so you look at the data this year, though, it's a very different story. All right, this data is through April of 2023. Spending on services has fully recovered at this point to where it would have been if the pandemic hadn't happened. You can look at other data too, hotel occupancy, the number of people going through TSA security, open table restaurant reservations. All this stuff says, hey, we bounced fully back, right? However, spending on goods has further to fall. It hasn't fully normalized yet. So ultimately what that means is I think there's more pain to come in the consumer goods sector, the economy, right? There's going to be more layoffs there, and they're not going to be able to get absorbed by the services sector. So ultimately that means the unemployment rate goes up. If that happens, consumer spending falls. If consumer spending falls, it usually impacts profits, right? And we're back to profits and interest rates. That's really how we do all these forecasts, guys. And so I don't want to overstate this. I don't think this is the end of the world. I don't think this is 08, 09. I don't think it's the COVID recession. It's going to be very mild compared to those, all right? But at the end of the day, I think it still does have an impact, and it still does probably mean we have volatility ahead in this market, right? So, that's why it's so important, I think, today to have like a financial market professional like Jay in your corner. There was this big idea, guys, after 08, 09. Interest rates are zero. Just buy an index fund. Have a robo-advisor do everything for you, okay? People that thought like that during COVID-19 lost their shirts, right? And so we are in a period of volatility. It really is, I think, this is when someone like Jay adds the most value, okay? So with that, guys, I think I'm right around 20 minutes, Jay. Let's go ahead and end prepared comments there, and we'll do some Q&A. Thank you guys again so much for having me.
Hey, thanks for joining us for our 2023 mid-year economic outlook. Everything you've been watching up until this point is our public version of the broadcast. Content past this point is reserved for our clients. If you'd like to come in and discuss your personal financial situation, give us a call at the office, 210-428-6250. We'd love to speak with you.